Over the last decade, we have seen emerging market assets substantially lag their developed market counterparts. But in 2020, this performance gap has narrowed, leading many to suggest we could be at a turning point. For 2021, we view the backdrop for emerging markets as favorable due to a variety of factors. First up, the fundamental environment. In 2020, certain areas of emerging markets outperformed as they were more effective in getting COVID-19 under control. This has been the case in North Asia in particular, with countries such as China and Taiwan able to flatten the curve more effectively than others and subsequently reopen their economies more quickly. At AB, we think that effective public health measures, the potential for widespread rollout of a COVID-19 vaccine, and the continuation of particularly accommodative policy should enable emerging markets to grow at above trend levels in 2021. Economic growth is a key driver of performance for more cyclical areas of the market, such as EM. This is because companies across the region typically have a higher degree of operating leverage, which means their profitability is more sensitive to changes in the economic environment. We also expect recent weakness in the US dollar to act as a tailwind for emerging markets. While a weaker dollar is not a prerequisite for EMs to perform well, crucially, it eases the pressure on those governments that borrow in dollars, allowing them to maintain softer monetary policy. As you can see from the chart, emerging markets have typically outperformed their developed market counterparts during periods of sustained weakness in the dollar. And given the US Federal Reserve's lower for longer interest rate policy, we believe this dollar weakness could persist. Sentiment is a key driver of EM assets. In recent weeks and months, we have seen a favorable turn in investor sentiment towards EM. As you can see in this display, when EM assets came under pressure in late March, early April, we saw large outflows across both EM equity and debt. This trend has now started to reverse, and we have seen some of the strongest flows in recent years return to both asset classes. This suggests an increasingly favorable trend in investor sentiment and a further sign of an improving technical backdrop. And finally, many are viewing the outcome of the US election as positive for emerging markets. It is no secret that the difficult relationship between the US and China in the last few years has been one of the key drivers of market volatility. This can be seen in the display, which highlights the clear link between deteriorating US-China relations and spikes in EM volatility. While we expect Biden to maintain some of the Trump policies on China, and that could be a source of risk for EM, we do, however, anticipate a more measured approach to the relationship, with a return to more traditional and predictable policymaking, which should give investors confidence around the stability of EM. Within our AB Emerging Markets Multi-Asset Portfolio, or EMMA as we like to call it, we aim to deliver EM equity-like returns, but with lower levels of volatility. In June of 2021, the portfolio will celebrate its 10-year anniversary, and I'm pleased to say that we have been able to deliver on our objectives over this time period. We have achieved this by looking across a diversified mix of equities, fixed income, and currency, and then using a combination of security selection, tactical asset allocation, and active currency management. This enables us to capitalize on equity market upside and the attractive yields on offer in emerging market debt, while also smoothing volatility for our investors. For instance, during 2020, we have been actively tilting our equity allocation towards areas of the market that have proved to be most effective at controlling COVID-19. This has largely been focused in China, Taiwan, and South Korea. You can see from the chart how the equity markets in these North Asian countries have materially outperformed the broader EM index. This is a function of their ability to get their economies up and running more quickly than others have been able to do. Despite such strong year-to-date returns for the indices shown in the chart, we see further room to run for these markets. We expect earnings growth to continue to be driven by secular tailwinds such as 5G, and we see further upside potential from here. By focusing the portfolio purely on Asia, would be missing out on other opportunities that we have in EM. On the world map, you can see that Emma is diversified across the globe, with the majority of our equity exposure in North Asia. Conversely, we tend to allocate to fixed income in markets such as Latin America and the Middle East, which is where we currently see the best risk-adjusted potential for bonds. Emma has the scope to unlock the full upside potential of emerging markets, whether that is tapping into the growth of the equity market or capturing the attractive yields on offer in parts of the credit universe. But perhaps more importantly, as we move through 2021, we do not feel that risk is completely off the table for investors, as there are still unknowns around rising COVID cases and the logistics for the rollout of vaccinations. As a result of this, we feel that investors should be mindful of the risks and consider a diversified portfolio such as Emma. The access all areas nature of the portfolio should enable Emma to deliver better risk-adjusted returns and a smoother investment journey for clients relative to the MSCI EM Equity Index.